7 rubbish investing advice. You should avoid it at all costs. As a disclaimer, none of what we say should be taken as financial advice. This is purely educational.
Now guys, if you're really interested in building a 6 to 7 figure portfolio, we've got the perfect solution for you. Head over in the comment section or the description to sign up for our free masterclass where you can get all these proven steps to achieve it.
Okay, MJ, the 7 rubbish advice that we're going to be sharing with you guys in today's video. So the first one we have here is stock investing is gambling.
Okay. Well, it depends. You see, the stock market is really just a mechanism, right? It's just a machine.
Yeah.
What you put into it is what you get out of it. So if you go in with the mindset of gambling, then it is gambling. But when people say that the stock market is gambling, they are making a statement that essentially what they are saying is, it's all about luck and it's all random and stuff like that. And, the people who get rich are those that get lucky, right? And certainly they are, quote unquote, these lucky people. Yeah. But one thing I want to bring up is, okay, if you ask people, is investing in real estate gambling? Most people will say,
yeah, it's not.
No, right?
Yeah.
When you compare the stock market, especially the US stock market, you will see that stock market in the US usually outpaces the real estate market, inflation adjusted, by a pretty big margin over like a 100-year period. Now in Malaysia, obviously we're not 100 years old, but our stock market don't do as well, but it's still, maybe 5-6%, a little bit more, right? In fact, EPF themselves invest in the stock market.
Yeah.
So if you're going to say that investing in stocks is gambling, you're saying that
your EPF money also is from
partially is gambling, right? Yeah. So what I'm trying to say is this. Why do we say one asset class is not gambling, the other asset class is gambling? The reason is because, and this is something Warren Buffett said in the past, people always prefer fixed 8% versus choppy 12%. Even though the returns are almost guaranteed for 12%, but people don't like the yo-yo, right? And that really is the difference.
Right, correct.
So your gripe is about the volatility of the market, but it's only gambling, in my view, when your time frame is very, very short. Because it's true, it's very, very choppy. But when you stretch it out longer, your certainty of returns is a lot higher.
Correct. To me, stock investing is basically like you're going to war. When you're going to war, are you going to war naked or are you going to bring your weapons and equipment and everything? Yeah. So basically what I'm trying to say is that when you are investing in these companies or even these quote unquote volatile assets, right? You need to be prepared. Of course, you need to, before you even put your money into these kind of companies, you need to study them first.
Exactly.
You need to do research.
Exactly.
And you need to also calculate what is the margin of safety, what is the likelihood of it going down or even going up. So those are all, I would say it's like a calculated risk rather than it's gambling per se.
Yep.
It's similar to the game of poker also.
Yeah.
Sure. If you got skills in poker, you definitely, look at those professional poker players, right? Of course, they all have this necessary skill that actually help them to make a lot of money. But some people say poker is a gambling game. The reason why it's gambling because maybe they don't know the strats or even counting probabilities of in the particular game. So that's it for the first rubbish
The more
advice.
knowledge you have, the less it becomes gambling.
Yes,
if I can summarize.
Yeah. Okay.
Number 2.
The second one we have here is investing in blue chip is safe.
Yeah, so you're going off the poker analogy. Blue chip is usually the... Actually, I'm not even sure what's the blue chip, but I know it's safe, right?
Yeah.
People usually think of blue chip as safe. And this cannot be further from the truth. Because another way to look at blue chip companies is mature. That means they're at the tail end of their
before going to the
cycle.
down. Yeah, correct. Yes.
Right.
Yeah, they're at the peak. The peak before it's going to the down cycle.
People look at the past and they say, they've done well, so they're safe. If you are talking about, let's say, a country or a country's bonds, maybe it's a lot more applicable, right? Like the US has never defaulted on its bonds since the founding. That's great evidence that they will likely not default going forward. Same with maybe Britain and all that, but maybe Argentina, not so. So in the bond setting, it's okay. But when it comes to a company setting, not always the case.
Yeah.
Right? The example we always give is, Star Media. It used to be a blue chip, right?
Yeah.
If you look at the company in 2006, 2007, you look at the numbers, it's fantastic. It's exactly like a blue chip stock. Growing, consistent, stuff like that. But of course, industries change. And so, essentially they evaporate.
Yeah, if you want a more updated version of example, right? Revenue Group.
Yeah, Revenue Group. That's another one.
Yeah, so you can see that they have all of a sudden a management issue.
Yeah.
Yeah, nobody can foresee that. It was once a darling for every single retail investors. And yeah, nobody can actually foresee that. Not even us, actually.
Yeah.
We didn't really expect them to actually barge into the office and steal documents. So yeah, even though they are quote unquote blue chip, but there's still risk into it because there's people managing that particular company. And not only that, actually, Revenue Group Berhad also actually has been proposing to diversify into property development.
There you go.
So I don't know what sign is that for you, but to us, it's not looking that good.
Yeah.
Yeah. So yeah, the third rubbish advice we have here is the infamous buy low, sell high.
Yeah, look, I mean, of course, on the surface, it's true, right? You buy $1, you said $2.
Yeah.
Simple as that. But I don't know. What do you think? What do you think of this?
To me, it's more of like you cannot really catch the bottom, and you cannot sell at the top.
Correct.
Yeah, I mean, that's just the game of the stock market lah.
Yeah.
I mean, nobody in the world can actually predict where is the stock market going to move in the next 1 year or two. Maybe in the 10-year horizon, maybe they cannot. Cause let's say if you're betting that US economy is going to be very well in the next 10 years, then sure. Yeah. But other than that, it's just as simple as that. Nobody can predict. That's it.
Yeah.
And hence the terminology of buy low, sell high, it doesn't really apply lah.
Yeah, it's too simplistic.
Yes.
Of course, we want to buy at the low price, sell at the high price, but you should spend time really figuring out what is the business doing. And to see it like you will see a real estate. Right? You don't ask for the price of a real estate every day. You are asking what you're asking. Is it good location? Can get rent near MRT or not? Is it freehold, leasehold, right? So you need to apply the same kind of rationality when it comes to the stock market. Because at the end of the day, if you strip everything on the surface, they're the same, right? You're thinking how much cash can the company generate over its lifetime, and then figuring out whether the amount of that cash generated is worth it to pay for the current price. That's it.
Yes.
But guys, before we move on, if you're someone looking to level up their stock investing skills and you need a lot more guidance, we do have a one-on-one program called the Mentorship Program. If you're interested, you can apply it in the comment section or the description.
Okay, so the fourth one is, cash is trash. Now, this is pretty interesting. Why it's interesting is because in 2020, 2021, I believe the stock market's returns were very lucrative.
Yes.
Everybody's like, I think that is the 1 year that a lot of millionaires start to pop out all of a sudden.
Of course.
Yeah. And then whether those millionaires manage to sustain their status or not, that's another story in today's date. But yeah, so cash is actually not necessarily trash if you are actually simply buying items, or maybe even buying stuff that is actually inflationary.
Yep.
So, for example, right, if you're actually keeping cash in your trading account and actually just waiting for the market to just in case, in case it crash, right, means you're actually well prepared. Cash is actually king during that time. Yeah. That is actually the time where people hope that they hoard more cash instead of being exposed in the market. So that strategy, it is actually pretty good. Yeah. But the reason why I say cash is trash is that I think people usually always say that because of inflation, it's going to eat up cash value.
Yeah.
Yeah. And then the thought of them holding cash is like, you know what, I shouldn't hold cash today.
Yes.
Because inflation is going to eat up. So, yeah. So I think that's the reason why I actually put it as a rubbish advice. But what do you think?
You always need to compare it with your interest rate. So the higher interest rate, the trashness of cash drops, right? Then the reverse is true as well. But beyond that simple formula, you also have to figure out, do you have the skills and the opportunities to invest in something that's going to do better than cash? That's important as well, because cash can be trash. Cash is trash to someone who's very good at investing. Cash is not trash to someone who don't know anything about investing.
Yep.
Right? So you cannot see things just in that simple term of, no, you should invest all your money, or no, you should always keep cash. If you're good, if you see opportunities, then yeah, you shouldn't be having a lot of cash. But if you are not educated, or you have the abilities,
it's best to keep cash.
Keep cash.
Instead of just simply like, I just buy this asset and then
and in fact, for a lot of people, their best bet to increase their net worth is by getting
more cash.
Promotion. Getting more cash. There are plenty of people, right, in Malaysia who have never invested a dime, but they are wealthy.
Yep.
For those of y'all, just some fun fact for you guys. About 4 years ago, I think I spoke to someone pretty high up at a bank in Malaysia. And he was saying that the typical person who put money in their FD has 3 million in FD, the average. Are they investing that? No. Would you, Mr. watching this video, like to have 3 million in FD? Well, some of you all probably have it already.
Yeah.
But I would suspect a lot of us, a lot of you guys watching don't have that, right? So it's not always the case that cash is a bad thing.
Yes, exactly. So the fifth one is when investors actually trust story more than the financials and valuation.
Yep.
So, I mean, it's as simple as that. When a company that it's, I think this example we can give like it's a .com era. Because .com era, there's a lot of newly company, as long as your name got a .com or tech in it, your valuation straight away will be skyrocketed. Yeah, without even knowing about how much money they're making, whether are they loss making or are they even cash flow generative or not. So yeah, I think this is just as a very simple advice only, but what do you think?
Yeah, I think you need to marry the two. So, you know that example of, there's this funny example of like water and vase.
Okay.
So, you know, you pour water into different vases in different shapes, then it looks different, right?
Yep.
So think of it like the story, right, is the shape of the vase. Financials and valuation is the water. Okay, you imagine, right?
Yeah.
So if you just have the vase, you know, you can't drink out of the water, right? There's no isi, there's no content.
Right.
But if you just pour the water, right, it's just gonna spill on the table with no vase. So you have a lot of content, but there's no structure, there's no story or no context.
Yep.
So that's how I would help you guys imagine how the story and the financials work together. You need to look at the financials to get a portion of a story. So if you imagine investing as a puzzle, without the numbers, right, you can't get the basic pieces.
Yep.
But to finish the puzzle, you cannot rely just on the financials.
Right.
You have to make some educated guesses or even projections based on the story or where it can go. For example, management. The numbers can tell you what the management have done. But going forward, how do you know how the management will behave, whether they're doing the right thing, going the right direction?
Yep.
So that's where understanding the story and the context helps a lot more.
Yes, correct. And actually another example that we can have here is the Adani group by Goldman. Yeah, the recent scandal, right?
Yes.
Yeah, so I mean, the management, there's a lot of, the management team itself, there's a lot of people who actually have gone through a lot of fraudulent cases. Yeah, I mean, that is one of the first telltale signs when you're actually investing in this company, right? And actually, I just want to peel back your example on the vase, right? Actually, I'll put it in a reverse. Just imagine that vase is your financials and valuation, and the water is the story, right?
Right.
But imagine that vase at the bottom, there's a hole.
Yeah.
So like you believing the story, right? The water, okay, it's good, it's clear, and it's gonna like fill out this vase.
Correct.
But in actual fact, when you pour, everything starts to leak.
Yeah.
So yeah, those kind of things that are the things you need to be aware of lah when investing in these companies. Okay, the last tool we have here is follow investment bank's target price. Yeah,
I think this is very, very simple. You have to understand that the majority of the reports you probably read from investment banks are what we call sell-side reports. So sell-side reports are designed not with you in mind. Well, actually, yes, with you in mind, but not your financial success in mind. It is you in mind in that they want you to create activity.
Yes.
Right? Because that's how investment banks make money. Right? They generate activity for a company that they're about to IPO or do some M&A for, and they want some activity. And so hopefully people read the report, get excited.
Yep, correct.
Reports that are a bit better are what we call buy-side reports. So these are designed for fund managers to make decisions. So that's a lot better. But ultimately, you only read, to me, an investment banking report after you've done the homework. Or if you're going to read the reports first, skip the valuation segment, like the target price segment. Just read their business description and avoid all the fancy adjectives, right? The positive adjectives like great, positive, forward looking, well, all that stuff. No, you look at some of the facts about the business, and that's about it.
Yeah.
Because one of the things about investing you need to know is the first bit of information that flows into your head stays there for quite long. It's like what's the inventory term? First in, last out. Okay, first in, last out. So you have to be very, very careful what you receive right at the beginning. And that's why it's important first to look at numbers or the more objective facts.
Yep.
And then form an opinion so that when you go into this opinion-based information, you are more guarded, you are more prepared.
Yeah, and also to add that these IB's target prices can actually be changed over time, because I think one of the most case study that I've actually seen is Sebab Dynamic. So there's this investment company, I'm not sure. We shall not name it, but basically when it was like, I believe it was around 1 ringgit and 50 cents, and then it went out to 80 cents, they were pretty bullish.
Yeah.
That's despite them having an accounting issue. So they still say that, no worry, it is still good.
Yeah.
So they still put like I pay 80 cents. They set their target price at 1 ringgit and 10 cents. And then it went lower. And then they say, actually, we kind of need to be more careful and cautious. Okay. So we reduce a little bit to 80 cents. Then you go tank. And then suddenly the IB's target price is like gone. This company cannot invest. Yeah. So there you have it.
So last one. Diversify equals low risk.
Yes. So I believe everyone also have listen to this kind of advice, right? Don't put your eggs in one basket. But I believe this is not a great advice if, let's say, you know what you're doing already.
Yeah.
And if, let's say, that you actually have a proven result consistently, then why should you actually diversify your skills? So for example, like if you're working in a job that you're really good at, why do you want to get a side hustle that could actually basically waste your time, that you can actually focus on doing your main job and actually make more money from there? Yeah, it's actually as simple as that. Yeah, but what do you think?
I think that, look, there's actually a lot of math behind this, that it's kind of like temperature. So you don't want to consistently live in like negative 20 or 30 temperature, right? But you obviously don't want to live in like 50, 60 or so. So you need to find like a nice sweet spot, right, for you. And of course, for the human body is like like 20 to like 30 lah. That's probably the best, right? So it's the same with diversifying. There's actually a number range that you should operate in. Without explaining the math behind that answer is like once you pass stock number 15, it's more or less a waste of time really.
Correct.
And 15 is really pushing it. So, but then you also don't want to go as low as, especially if you have a large chunk of money, you don't really want to go as low as like 6 or 7. Yeah. But then again, some people do get away with 5. So it's definitely possible. Yeah. However, people need to understand that there are 2 aspects of diversification if you're going to do it. The first is, of course, the number of investments that you have. So number of stocks, let's say. The second thing, which is actually very important, is correlation. So meaning you can say, you can listen to what I just said and you can say, wow, okay, I'm going to buy, let's say 12, right? That's a sweet spot that I like. And that's going to, that's a decent number. But if all those 12 are in industries that's, let's say, reliant on oil and gas, all 12 of them, you're not actually low risk. You're not diversifying properly. You need what we call uncorrelated bets or uncorrelated positions. So you can have some in oil and gas. Then you want other companies that are not correlated. Now, important correlation is twofold. One is positive and negative correlation. So I only mentioned positive correlation just now, which is companies
same industry.
But you also don't want to fill up your portfolio in negatively correlated industries. So you don't want to, let's say you think oil and gas is going up, you don't want to buy companies where they will be affected if oil and gas goes down. They'll be affected negatively when oil and gas goes up. So companies that rely a lot on fuel and things like that. What you want to do is uncorrelated. So for example, if you are in oil and gas, the next group is you should probably that you can consider would be something like real estate or something like financials, where they're really not linked. But of course, you need to look at the details, right? Because even financials, let's say you invest in a bank, they are heavily exposed to lending money to oil and gas. So they become correlated. So that's a second thing, just be uncorrelated with your investments. And once you fill up your portfolio with 5 or 6 different industries that don't talk to each other that much or uncorrelated, you're quite well diversified already.
Yeah, correct. And maybe I'll just put a last bit is basically diversification is how many kids you can actually manage.
In a way,
Yeah, because you have to be aware of every single company's financial situation, what is their prospect moving forward, which is going to take up your time. So imagine if you're investing in 30 companies, you need to read like 30 companies of annual reports and also all of the updates that you need to know. So I think that's about it for today's video. And these are the 7 rubbish advice that you need to avoid in all costs. But before we go, this is FIRL Pro's January 2023's performance. It has been pretty good. You can see one of the stocks is actually now up 88%. We're hoping it to go like maybe 2x hopefully in the future. But other than that, every single stock is actually on the green right now except for one stock, but it's actually quite minuscule at 0.63%. And if you want to know more about FIRL Pro, is basically our program that we actually we provide you minimum 2 stock reports every single month and also 1 big picture report. Big picture report is basically telling you where the economy is heading to. And also it comes with the free SIB course. But if you are still not convinced yet, you still want to read more about what you want to know more about this, don't worry, we have a free sample for you. It actually covers both FIRL Pro and also SIB program, and you can get the link for this free sample down in the description and comments.
Yes, guys. And thank you for watching all the way. And hope to see you in the next video.